going to go ahead and get started. Good morning and welcome to GovInvest's monthly webinar. We have an excellent team of presenters representing multiple perspectives today, including issuers, municipal advisors, and of course the legal perspectives. A few housekeeping notes to consider. We will be answering questions at the end of the presentation. You may submit questions in the question or the Q&A box, and we'll be monitoring those and answering as many as we can at the end of the seminar. And our goal will be to send both the PDF of the webinar and a webinar link by the end of the week. So with that, I'll get started. We have a great bunch of presenters today, myself excluded. My name is Dan Matuszewicz. I've been a recent addition to the GovInvest team of consultants on our customer success team, which means myself and other senior industry consultants are available at your disposal as part of your licensing agreement with GovInvest. As you know, I've been a longtime advocate of active management of pension obligations, and you're probably already tired of hearing me yammer on about pension obligations. We also have Brian Forbath from Stradling, Yoka, Carlson, and Roth. Is one of the leading bond counsel firms in the country and in the state of California. For each of the last 5 years, Stradling has served as bond counsel, disclosure counsel, and underwriters counsel on more bond transactions in California than any other firm. Brian is the president of Stradling and has been a municipal finance lawyer for more than 20 years, focusing on representing cities, counties, and special districts on a variety of complex transactions. Brian has served as bond counsel to numerous agencies in connection with their UAL restructurings, including but not limited to cities of Arcadia, Coachella, Chula Vista, Commerce, Glendora, Oceanside, Ontario, Orange, Pomona, Riverside, and El Cajon. We also have NHA representing the municipal advisor's perspective, and NHA provides municipal advisory and consulting services to California cities. They have 8 practice groups, one of which is their pension group, which is led by Mike Meyer. Mike has worked in public finance for 18 years. The first half, he was on the underwriting side, and the last 9 years he's been on the advisory side. Mike and the pension group have served over 50 agencies over the last few years and is one of the more experienced firms in the UAL restructuring space, having worked on or currently working on 15 UAL restructurings for over 1.7 billion in UAL transactions. Mike will be joined by his colleague, Eric Scriven, a principal at NHA. He has 30 years of municipal finance. He is a 30-year municipal finance veteran with NHA who has worked on all of the firm's UAL restructuring projects. We also have, from the issuer perspective, Edward Enriquez. We're pleased to have. He's got 25 years of public accounting and local government experience, 9 years with the city of Riverside, and he spearheaded the city's 3-year CalPERS challenge process involving multiple stakeholder groups and issued 432 million, or 2/3 of their UAL with public obligation bonds recently in 2020. So, many agencies have turned to POBs and other forms of UAL restructuring, even though there is considerable risk and it can be a lightning rod topic the word POB by itself, but there's a confluence of events and reasons to consider POBs. The resurgence mostly has to do with historically low interest rates. We've got steep, challenging UAL schedules. We're all struggling with the revenue uncertainty relative to COVID-19. And so, after exploring other options of restructuring without municipal securities, and hopefully you've exhausted other cost management strategies that, some more agencies are turning to POB as a solution. And there's been some market acceptance of more favorable issuer terms that than were available in the past. Mike Meyer will be speaking to some of those. The typical reasons people are looking to do that is enhance their fiscal stability, budget predictability, resiliency, and cash flow savings, and potential interest savings. So there are some cautions that should be heeded. UAL restructurings are a very complex topic, and it requires more education and additional burdens on the issuer to make sure you educate your stakeholders fully and transparently. Requires more intense quantitative analysis. Mike and others will speak to some of the GFOA guidance on the topic that always comes up. Some of the market risks that GFOA warns are very real and should be considered carefully. We'll talk a little bit about stress testing, and ultimately, so your board can walk into a deal with their eyes wide open. All that to say, don't rush into a deal. Take a thoughtful and deliberative process, ruling out all reasonable other options for your agency. So our NHA and straddling guests will be speaking to the legal structure, kind of the recent market activity that you'll see that spiked, some of the potential benefits and risks, and what you should consider for a holistic evaluation process. Edward will provide the inside perspective as the issuer, and then I'll close things out with the GovInvest perspective. And with that, I will turn it over to Mike Meyer with NHA.
Brian. I think, Dan, it's going to be me for the first slide here. So if you can go to the next slide, that'd be great.
Sure.
Thanks everybody for being with us this morning. We appreciate the opportunity to be here with you. So just at a high level, a UAL restructuring is as simple as an agency borrowing money to pay off some or all of its CalPERS UAL obligation. Essentially, bonds are issued to investors or to a private bank. And essentially, the goal is to convert what would be the unfunded liability payoff at essentially 7% debt to CalPERS with a lower interest rate debt, currently, between 2.6%, 4.25%, depending on credit rating, structure, length of term, and market conditions. So essentially, lowering your payments by doing this. The typical method is through a pension obligation bond for cities, counties, and special districts. We'll talk about that a little more in the next slide. And then for cities, counties, and school districts, there's a court validation process that we'll talk about a little more on the next slide as well. Alternative structures include the issuance of least revenue bonds, and then utility districts or special districts can utilize a revenue bond structure rather than the standard judicial validation or lease structure. Dan, if you could go to the next slide for me. So essentially, for issuance of pension obligation bonds, a validation is required to confirm that the UAL as existing debt that can be refinanced. And so many ask, well, why do you need to do this? And essentially, it's really because cities, counties, school districts are subject to the constitutional debt limit. And that's set forth in Article 16, Section 18 of the Constitution, which says that no county, city, town, township, board of education, or school district shall incur any indebtedness or liability in any manner for any purpose exceeding in any year the income and revenue provided for such year without the assent of two-thirds of the voters of the public entity voting on election to be held for that purpose. So that all cities, counties, school districts are subject to the constitutional debt limit. However, there are certain exceptions to the debt limit, and those include the lease exception, which we'll talk about in the context of lease revenue bonds, contingent liabilities, in other words, an obligation that's contingent upon certain events happening. And then the third obligation, the third exception, is an obligation imposed by law, and that is the theory pursuant to which pension obligation bonds are issued. In a POB context, we judicially validate that obligations underneath the PERS contract to fund the UAL is an obligation that's imposed by law, by statute. Essentially, you enter into the PERS contract, you've got a contractual obligation to make the payments. Statutory law requires you to make those payments. So then, once you have an obligation imposed by law, you have the ability to use what we call the refunding bond law in California to refund that obligation. And so pension obligation bonds, from a legal standpoint, step into the shoes of the obligation to fund the UAL underneath the PERS contract and are not what I put finger quotes around a new debt for of the city or county. It's essentially stepping into the shoes of the UAL. So what we do is we file a judicial validation action confirming that this is an obligation imposed by law and confirming the ability to refund that obligation underneath the refunding bond law. And then bond counsel relies on that judgment that's granted by the court in rendering its legal opinion that the pension obligation bonds are legal, valid, and binding obligations. So this, the validation action, is what we call an in rem action, and whereby the court and the city have to receive jurisdiction to render a judgment by publishing a summons notifying the public and interested parties of the filing of the lawsuit. And that requires publication and usually notification of bargaining units as to the filing of the complaint. And so there's a whole process that has to go through with the courts. It usually takes about 3 to 4 months to complete. However, due to the pandemic and shutdowns in some of the court systems, there's been certain instances where it's taken longer than that. Other courts have been more proactive and it's moved faster than that. But once you have a judgment, the bonds are issued and they're paid from any legally available source of funds, usually the general fund, with contributions from enterprise funds that for their pro rata share of those contributions. But it's important to realize that pension obligation bonds are unsecured obligations. There is no pledge or lien on the general fund at all. And so some of the pros of the pension obligation bonds is you don't need to have assets like a city hall or fire stations or police stations or something as security underneath a lease structure. It also has the same rating as the issuer credit rating, which is normally 1 notch higher than a lease structure. And currently those interest rates are lower than on a lease revenue bond structure. The other positive about, the other major pro for a pension obligation bond is that you receive a judgment, and once the judgment's been entered and the 30-day appeal period is run, your pension obligation bonds are beyond legal challenge. The cons for the POBs are it is a 3 to 4 month time frame. You could get an answer to your validation, which could derail the process. And then there could be limited appetite for direct placement investors and less likelihood to get bond insurance because it is an unsecured obligation. The other structure, lease revenue structure, that requires the city to use or the county to use certain assets to secure lease payments, just like you would on a normal capital financing. The pros of that are there's no validation process that's required. It provides more flexibility with the use of the proceeds. I should go back and say that in the context of pension obligation bonds, because we're using the refunding bond law to sort of extinguish one debt with another, the proceeds of those POBs have to be delivered to CalPERS at closing. There's not an ability to dollar cost average your contributions. Whereas in a lease structure, there is some ability to stagger your payments and dollar cost average, and maybe use a 115 trust in order to satisfy that. Negatives to the lease structure are, you're using or securing the lease with assets of the city, and so from a fundamental standpoint, does it make sense to lien or leverage City Hall, the police stations, the fire stations to pay off this unfunded liability or not? And that's a policy decision for the elected officials. It's also one notch lower normally on a credit rating, so there's a higher interest rate with that. And then the utility revenue structure at the bottom, that's really for special districts that aren't subject to the constitutional debt limit. They're able to just issue revenue bonds or pension obligation revenue bonds that would be secured by pledge and lien on revenues of their system. No validation or assets required in connection with that. Some of the negatives of that is that when you're moving your pension expense, which is an O&M, down to your debt service line, that could and likely will, just the math will function as to lower your coverage, and so it might require you to raise rates potentially faster to meet any sort of rate covenant that you have. And with that, I'll turn it back over to Mike on the next slides.
Appreciate it, Brian, and good morning, everybody. Mike Meyer with NHA Advisors, and I'm on slide 9 here. As Dan mentioned in the beginning, we've seen pretty big uptick in activity in the UAL restructuring market. So this is a snapshot of, I think, the majority of agencies who have come to market in the last 2 years. There's about 35 different agencies. As you can see, primarily cities, one county of Riverside, and then a handful of special districts, some fire districts and utility districts. About 80% of these transactions utilized a traditional POB structure, with the remainder utilizing either a lease structure or utility revenue bond structure. There's a few here you can see in the footnote that are one of a handful of California agencies that do collect a dedicated pension tax override. And so just given the enhanced security of those POBs, those did qualify for bond insurance there, the El Monte, Inglewood, and Montebello transactions. For the most part, these have been issued utilizing a public offering method of sale, just given that we've seen lower interest rates using that method, although there have been a few smaller issuances that have been privately placed with a bank. In terms of credit ratings, we've seen the range from the high BBB category up to AAA, but for the most part, I'd say on average, most of these agencies have been in the high A to AA category. Interest rates generated on these transactions, historically speaking, and relative to a lot of the POBs that were done 10 or 15 years ago, very, very low, but still a pretty broad range. We've seen as low as 2.6%, 2.5 percentile, up to a little over 4%. And those interest rates are highly dependent on one, credit rating of the agency, the term, is it a 15-year bond, or is it a 30-year bond, or somewhere in between? And then obviously market conditions. We've seen tremendous volatility in the last 12 months in terms of just pandemic related concerns, the election, lots of volatility in supply in the bond market. So not uncommon to see very quick movement in interest rates to the tune of 30 to 40 basis points just in a month's time. I think generally speaking, though, we've seen a growing level of comfort by investors to purchase POBs, even though they're unsecured, which has translated into lower credit spreads for these bonds. I think the most recent deal was priced about a week ago, the city of El Cajon. I believe those interest rates were under 3% for a AA rated POB. And we can move to slide 10, Dan, if you don't mind. I know we don't have the time or slide capacity to really go through the restructuring strategy for all of those agencies we just looked at, but I think one very important concept that we want to get across is that there's no one size fits all strategy to reshaping this large liability. And, that's obviously in addition to having the ability to borrow at lower interest rates, it's really the flexibility to reshape this debt in a way that works best for each individual agency. And there's no real right answer to what that looks like. So just a handful here to show you some differences. City of Ukiah, they went with a 1% escalating repayment shape for the first 20 years, and then a linear decline to 2050, a little bit of upfront relief to deal with pandemic-related revenue declines. City of Riverside, and you'll hear from Mr. Enriquez in a few slides, they chose to really just smooth out that peak, but then keep the payments at the same level over the last 10 or so years. You could see that in the purple line on the top right. Bottom left, you have the City of Hawthorne that did a 30-year level payment structure. And then on the bottom right, West Covina, who recently issued last summer, 25-year transaction with a 2% escalating repayment shape and a bit of upfront relief to bolster some of their reserves. So again, no one size fits all to how you can restructure this liability. We can move to slide 11, Dan. Just want to touch briefly on the benefits, but really spend more time on the core risk of any UAL restructuring. Talked about the lower interest rates versus what CalPERS is charging, the 7%, which is the current discount rate. Really the big benefit, I think, in our opinion, from the advisor's point of view is having the flexibility to take this for what for most agencies, the largest debt on your balance sheet, and reshaping those payments that are more conducive to long-term fiscal sustainability, to budget predictability, and also just resiliency to future downturns. And so really an enhancement to fiscal sustainability in a lot of situations. That peak or that shark fin in payments that every at least CalPERS member is currently facing, the way your UAL amortizes, smoothing that out does provide a significant amount of projected budgetary savings, especially in the next 10 to 15 years. And then, as I mentioned before, there are some structuring techniques to help address near-term needs, perhaps to address pandemic-related revenue declines. The core risk of any pension bond or UAL restructuring is what's called reinvestment and market timing risk. This is the core concern of GFOA. It is a valid concern. There's not a lot of ways to avoid this risk, but just to quickly define it, savings is not guaranteed on a UAL restructuring, but it's ultimately dependent on what CalPERS earns in the future. And of course, that is unknown at the time of issuing the bonds. And so the rule of thumb is that an agency who does a UAL restructuring is better off as long as, and when I say better off, it means that there's present value savings to the refinancing, would be better off if CalPERS earns more in returns than the rate paid on the bond. So let's say an agency goes out and borrows at 3.5%. If CalPERS earns above that 3.5% on average over the next, let's say 25 years, then the agency would have been better off doing the restructuring. Now, if CalPERS earns less than 3.5%, if that was the bond rate, that agency would be worse off. A subcomponent of this is what we call market timing risk. When you do a restructuring, you are giving CalPERS or whoever the retirement fund manager is, depending on your agency, a large sum of money at one point in time. And so any gains and losses, especially in the near term when you have more assets exposed to the market, are really magnified. And so that's something to take into account. And as we'll get into in a few slides, this risk obviously we recommend that it's well understood because it is a core risk of any restructuring. But this market's really evolved in terms of the types of stress testing that you can do to really look at what a restructuring might look like under some more pessimistic assumptions. So obviously a restructuring may look really strong if CalPERS earns 7%, but what if there's a stock market crash? What if we have another 08 recession? What if CalPERS only earns 4.5% instead of 7% over the next 20 years? Those are things that you can quantify and look at as we'll get into. And so we can move to slide, I believe, 12, Dan. I mentioned the core concern of the GFOA that came out in 2015 with the list of concerns and recommended against issuing pension bonds. We highlighted the top one because, again, this is a very valid concern. It's a big risk, reinvestment risk. There is a chance that CalPERS does not earn above the rate paid on the bonds. That risk may be low if you look at historical trends by CalPERS, but that risk does exist. And as I mentioned before, we often recommend some sort of stress testing process to really make that less of a black box and really illuminate what could happen with a lot of what if scenarios. Because you're going to get this book after, I'm not going to spend time going through the rest of these concerns, but generally speaking, these were very applicable and valid concerns for a lot of the pension bonds issued in the 2000s, but the market has changed quite a bit. And so I would say these aren't that applicable anymore. If we could turn the slide, Dan, I know there's, without knowing exactly which agencies are on today, I know there's probably some that are very small and have $1 or $2 million unfunded liabilities, and probably some very large agencies in the billions. And so it didn't really make sense to tailor any sort of analysis. But one concept that has come up as part of the evaluation process in all of our projects is really, do I do a short maturity at a slightly lower interest rate, or do I extend it out? And obviously this is an extremely simplified way of putting it, but it's a concept that we think is important to talk about. And you can see here in the chart on the orange line, this is a 20-year transaction, slightly lower interest rate and more cumulative savings than if you were to do a longer maturity, because you're saving a lot in the out years in the back end. As you can see, though, that orange line is a bit higher in terms of annual payments. So that means that there's less savings over the first 15 to 20 years. And what that also means is that there's a little bit less capacity and resiliency to absorb any future shocks by CalPERS in terms of new UAL that gets added on. Conversely, if you look at the blue line, a longer maturity, slightly higher interest rate in today's market, less cumulative savings because you do have some added payments on the back end, but you do have more savings over the next 15 to 20 years, as you can see from that lower blue line, and in turn also more capacity to absorb new UAL that might get added on in the future. So again, very simplified way to look at it, but this is something that is part of the evaluation process if you were to explore this concept in more detail. We can move to the next slide, Dan, if you don't mind. This is, I think, my last slide before I turn it over to my colleague, Eric. Probably want to leave this up for a couple minutes. I think it's very important. As Dan mentioned, this is probably the most complex type of debt instrument that a municipality could undertake. And there's a lot of moving parts as part of a thorough evaluation process. And I want to talk a little bit about those. First one being education. It's not the easiest type of transaction for electeds, residents, other stakeholders to understand. And so we really encourage that this information, especially in the beginning, is laid out there with facts, talking about options, talking about risks, perhaps in a workshop setting, and then obviously keeping that community engagement going through the process, and oftentimes getting guidance during that process. And I think Mr. Enriquez will talk a bit more about how he dealt with that in the city of Riverside and their process. in terms of the, I come at it from the perspective as an advisor, and I get pretty deep in the quantitative aspects of these transactions because there really is an infinite number of ways you can structure them. And so really putting those all out on the table is important to look at the trade-offs. And so obviously different sizes. We have some clients that have done very targeted takeouts of their UAL, so maybe 25% specific amortization basis. And we've had some that have a very thoughtful plan to take out the whole thing as well. Obviously, lots of different shapes in terms of repayment schedules, looking at different plans. So, do you want to prioritize general fund savings by targeting the safety plan versus maybe perhaps a more equitable approach, looking at, taking out both safety and miscellaneous. And then obviously tailoring those options to your specific set of goals, your risk tolerance, and of course, any other constraints that you might have. That brings me to my third bullet, which is a word we use a lot in these projects, which is optimization. It's typically a fairly methodical approach of how to refine these options. And once you start dialing in, what options are most viable, there are lots of ways you can really optimize the savings outputs, the resiliency outputs when you do the stress testing by looking at the most efficient amortization bases to pay off, at least with these CalPERS restructurings. And so you'll see that once you start looking at taking out short versus long bases, those all have different results when you look at savings and resiliency and all that. It's also a very dynamic process that is part of the initial evaluation, but also in our experience can last through the day of pricing the bonds. And so we've actually had some recent experience where underwriter will tell us that an investor has specific interest in certain maturities, perhaps in the middle years or the long years. And there's ways that you can in real time, modify which amortization bases you're paying off to create, the space for that level of a bond just to meet that investor demand. But with, all of this is really with the objective of maximizing the results of any restructuring. Second to last bullet here, I talked about the risk. Very important to make sure that all stakeholders are aware of this risk. Dan, I think, is going to talk a lot about the stress testing process that GovInvest can help with, whether it's your advisor, a GovInvest, an actuary, or an underwriter. I think very important to look at, where do you stand with and without a POB if certain things happen and, certain underperformance CalPERS investment return type scenarios. Once you get a better handle on that, there are techniques to address some of those risks, not completely eliminate, but on the structuring side to create enough resiliency to handle some future shocks. Dollar cost averaging strategies, perhaps using non-POB structures or even staggering your POB issuances. And then even perhaps non-debt related, but putting policies in place that will really lock up those savings in the early years so that you do have the resources to redeploy into the market if there was a downturn is another form of strategic dollar cost averaging that's not really part of the bond financing. And lastly, a pension funding policy, in our opinion, is very important to this process. And I'm going to turn it over to my colleague Eric Scriven as we flip to the next slide to talk more about that.
Thanks, Mike. Before I introduce Edward from the city of Riverside, I think from the advisor's point of view, we want to put a exclamation point on the process versus heading towards an inevitable result, which would be a transaction. As far as the process is concerned, it's about education and evaluation. Part of that process we think that is extremely important is the policy that sort of drives the effort. And one of the most important policies that can be undertaken whether you issue a bond or you do not is a pension funding policy. And this is really sort of a document and an effort to clarify whether for internal stakeholders and potentially external stakeholders and other viewpoints. But what it does is it explains to your public and the stakeholders in the city how the city plans to address the largest liability on the balance sheet. It also, if you end up doing a transaction, it also helps you understand where you might be able to strategically put your potential savings and provide safeguards for future elected officials, as an example, to use those future savings and general fund surpluses towards strategic uses. And of course, when you have good policies in place that are forward thinking, this can be very helpful for the credit rating process. And we've seen that recently underscored. A couple of examples, I think we'll hear about it a little bit more from Edward in the city of Riverside, was a very groundbreaking, in our mind, approach to looking at various levels of savings and under more pessimistic views and projected, and what they would do with those savings to buttress their reserves and accelerate their debt repayment in the future, and just in general create more resiliency. We're working on a transaction right now in the city of Chula Vista where we're seeing that theme carried forward with a little bit more of a granular approach to filling up certain buckets of emergency reserves and general fund reserves prior to the Section 115 buckets being filled up, and then potentially calling POB bonds in the future. So we think that the process is very important, and the education evaluation effort is very important. And to put a little bit more light on that, we think that the process in City of Riverside was extremely valuable for the electeds. And as an advisor, we really appreciated being on the sidelines for that. Edward?
Thanks, I appreciate that. Good morning, everybody, or good afternoon, depending where you're at. So at the City of Riverside, we like to think we're unique, but just some background, an overview of the city. City size, a little over 330,000 folks. We have a $1 billion budget, and we had a UAL as of just prior to our pension bond issuance of about $630 million. Part of the struggle, not just the size of the UAL, was the ever-increasing payments over the next, at that time, about 10 years, 10 to 12-year horizon. So when I took over at the helm of the city about 2.5 years ago, I was faced with these and many other budgetary challenges. And I spent a lot of time educating myself in the process. So next slide, please. So what we did first was back in 2018, we got together as a group and we defined kind of what we call Riverside's CalPERS Challenge project. And given the unfunded obligations, what's our collective challenge? And we call it the CalPERS Challenge. And it's really how to effectively secure the solvent financial future of the city, its employees, and its retirees while ensuring the delivery of public services and stewardship of public resources. So this was kind of our mantra to start out with, and we included it and discussed it quite often in whatever publication we had. If you go to our website, we have a section carved out at City Manager's office called the CalPERS Challenge webpage. And in there, you'll find a lot of resources that we've put together, all the presentations I gave to committees and councils, all the documentation, and there's also an FAQ that's pretty extensive. We had a lot of questions and from not only internal but external stakeholders. And what I'd like to say, just generally speaking, is you can never do enough education, especially in this area. I think we educated just so people understood what it is we're facing. They understand generally what pensions are, but the nuances involved in that, and why are things escalating, and why did they get to where they were, and what does it mean to have a UAL, and what does amortization mean? So we educated the heck out of this. First, I had to start with my city manager and get him comfortable. And then once we got the city manager on board, we developed a CalPERS challenge team back in 2018. We formed a team of about 6 employees internal, HR, finance, and city manager's office had a representative. And we met literally on a weekly basis. And we defined the challenges that we had. We defined the issues. We came up with presentations to give, communications to staff, communications to city council as part of the education process. We also had our budget engagement commission as a result of our education develop their own ad hoc committee because they wanted to be informed and understand the process, understand what it means to ultimately issue a POB. But really, I think we did ourselves a lot of benefit by consistent and constant stakeholder engagement from the outset. We put together as part of this team a list of 15 to 20 items to address and talk about whether we could implement changes. Of course, we did things like we talked about prepaying the UAL at the beginning of the year and what that meant for the city and how much we could save. As a point of reference, our last UAL payment to CalPERS at the beginning of the fiscal year pre-POB was in the neighborhood of $40 million. And by prepaying it, we saved about $1.5 million, and we did that for the last 3+ years. So educating folks on what it meant to do that, what it meant to make additional discretionary payments. If we looking at things such as cost savings measures for pensions, how would we go about MOU negotiations? So we had a whole list of items, and I want to stress also that it was never to get to issuing a pension bond. It was all the things that we could think of to help us mitigate over the course of time our challenges, and they're quite significant, and they continue to be quite significant. Pension bond happened to be one of those ideas, so it wasn't at the forefront, but it was something that we were going to eventually have to get to and talk about. So again, we talked a lot about educating. You can never do enough of this. As painstaking as it may be, it's important for people to understand. And even when they do understand, they may not buy off on it, but I think they have a better level of comfort, understanding that you know what you're dealing with and what we're ultimately charged to do. And of course, we had a lot of cost management strategies, and we had some actual strategies come out of those stakeholder discussions from not only external folks, but internally staff had put together questions and lists of things that they thought we could address. Some a little bit unusual, and we did get someone say that we should buy a lottery ticket, but that being facetious in that respects. But there were a lot of good ideas, some of which we were able to leverage and help with this cost mitigation. Again, this website was important that we set up. We wanted to be transparent, and that's also the key, transparent and informative throughout the process. It was no holds barred. We talked about everything. We talked about the challenges and why we're here, and what we're coming off of several good years for staff of significant pay raises that ultimately add to our issues. So they say imitation is a sincerest form of flattery. Our website, we developed it, we put it together, and we noticed probably about 1.5 years into this process that a local city in the region virtually copied our website verbatim. They took our FAQs, they used it as theirs, and we were fine with that. We just got a chuckle out of it. We did not reinvent the wheel. I don't think I mentioned this to Dan, but I looked to Dan's information for help and guidance and what he did over there in Newport Beach, and I may have used some stuff in our approach. So it's free for anybody to use. We have no copyright on it, but I just thought it was interesting that another city would verbatim. I think they just changed the font, made it a little prettier, but it is our website, word for word. Pretty much. Next slide, please. So when we got past all the other strategies and issues, got to a point where we started looking at POBs, or I started looking at POBs, and I'll tell you that I was skeptical. at the outset, just my inherent nature. Conservative, this was, I knew, not going to be an easy lift. I've heard both sides of the equation in terms of pros and cons. So when I went into it, summer of 2019, I went in, all in. I educated myself. Starting at that point in time, I made sure I went out for an RFP and got what I believe is one of the best advisors in this area for pension bonds with NHA. I worked with Mike Meyer exclusively, Eric as well, but a great group to help us through this process. And I think we educated both ourselves during our lengthy discussions. I think I probably added some gray hair to Mike's head because I had a lot of questions, and I don't think you can ask enough questions through this process and push your advisors to respond. I did a lot of research on my own as well, outside of those discussions with Mike about things. But it was really a lot of interaction between the two of us, looking at analysis, thinking about concepts. We had several meetings through this process as we moved through it with the city manager. Again, I had to get him comfortable in understanding the process. I still wasn't sold early on. I was just looking at it as another alternative. And I think that's the way, obviously every agency situation is unique, but it's just one of several items, many items that we did to try to mitigate our increasing costs. So this wasn't for us a panacea, cure everything. And we started in the fall with our workshops coming out of a CalPERS challenge, engaging our advisors, meeting at least on a monthly basis with the finance committee and city council for updates on items, things that we've done to address the issues, just talking about cost management strategies, educating them on what a pension bond is, educating on some of the terms for us that come out of PERS in our unfunded liability and what that means and how that's calculated and generated. So just a lot of discussions, a lot of pros and cons and feedback. I had, of course, in city our size, we have a lot of gadflies who come out of the woodwork to discuss these things, and a lot of them had some good points. A lot of them just didn't understand, but I think educating people, they became a little more comfortable as we went through the process in the winter of 2019, heading to 2020. We had some more heated discussions in committee, made some presentations. One of the things that we did from my perspective to ensure I was comfortable moving forward with this, because issuance this size, a $432 million POB, really wasn't where I was starting at. And the issue that's that size is probably the single largest issuance in the city in one fell swoop. So there was a lot on the line, a lot I had to think about, a lot of issues and questions, but we engaged an external actuary to do some analysis for us. And prior to my tenure with the city in 2004, 2005, the city issued pension bonds. I think it was the neighborhood of $120, $130 million at that point in time to pay down some of the liability. So what I did is I asked the actuary to look at those POBs and how did they perform through the 2019-2020 period to give me a better sense of what I would be looking at, because you can get all the projections in the world based on various assumptions, but in actuality, you need that actual data to tell you, how things have performed. It's not necessarily a predictor of future performance, but it gives you a good sense of what's what you can expect. So they did that, and at that point in time, it looked to be the city saved approximately $60 million over the course of that 15-year period or so by issuing those bonds. So once I got that information, I felt a little more comfortable moving forward. We hired a financing team, and once we got the financing team together, of course, bond counsel Brian Forbath, his group, NHA, I believe we had Bank of America was one of our underwriters in conjunction at that time with Raymond James, and we had them jump through a lot of hoops during analysis, because I wanted to be sure I evaluated as many options as possible You have, a lot of ways to look at this thing. Structure-wise, I wanted to make sure that we looked at all different structures and what that meant for the city. The things I heard through this education process was, oh, you're just going to kick the can down the road. That's all you're doing. You're just kicking the can down the road. And people didn't really understand what we were doing. So as you saw, Mike showed our structure, where I ultimately settled on was I needed that relief in the middle years. I knew the next 10 years or so were going to be challenged for the city. And I didn't want to be perceived as kicking the can down the road. So I wanted to make sure there was no savings on the back end. It could have pushed it out. It could have lowered our payments, but I didn't want to, I didn't want the next person sitting in my seat have to deal with issues 15 years from now when the pension bond payments are still pretty high. So I wanted to follow that same trajectory. So that's kind of ultimately where we settled on. And as we went through all these options, we stress tested the heck out of it. Gave several presentations to council, and of course with the pandemic going on, it made it even more challenging to go through that process. But we had a lot of extensive discussions with our budget group, our budget committee, and with our council to educate them, to provide some of the education that I got and I was comfortable with going through all this analysis. And a lot of it was high level, but ultimately they had to be the ones to buy off on it. And what they ultimately settled with was, okay, well, we understand what you're saying. We hear you. However, we have some concerns. Interest rate was one of their concerns. So they set a threshold for us. And I'll also tell you, going into this process, I thought I'd issue a POB anywhere in the neighborhood of 150 to 200 million. But as I did more educating myself, looking at the data, I had to take a couple of deep breaths, but I thought, we got to do better than that. And we finally settled on about, satisfying 90% of our funding ratio with CalPERS, and then about 2/3 of our UAL. I know I've seen cities do 100%, and it's really, what you can handle and what makes sense for you. But I thought, that was enough for us in terms of the risk. It was risky just in general, but I felt like, okay, this is where we're going to end up. And I never thought we'd be at $400 million POB, but it made sense as I went through all the data and the analysis. And then, of course, with COVID, that turned the world upside down. And as we're ready to issue a POB, the financial markets just stopped and the market fell out. Good or bad, for us, we waited and waited. And as the market came back, we eventually ended up pricing and closing in June. And I think we delivered what we had conveyed to our council in terms of the objectives. And I think we'll talk about that possibly. Next slide, please, Dan.
So Edward, I do want to point out that we're down to 11:25, so we'll have to kind of move things along.
Okay. So we had multiple objectives, and I'll just go through these from 12 o'clock position, but we have multiple objectives, and I think it's going to be different from you, for you and your agency if you ever go down this period. But you can see I was looking for some budget flexibility. I was looking to make sure that I had no savings in the out years. And we had this target rate, if you see about 7 o'clock there, the council said it has to be below 4%. We were fortunate at that time. We issued a total interest cost of 3.69%, and I was completely happy with that, given the market. We had some flexibility that we made sure we had for a 10-year call. So we had our objectives lined out. It wasn't just, hey, let's pay it down and hopefully cross our fingers. We wanted to meet multiple objectives, and I think you can see here they're listed, and that's what we did. And I'm happy with the end results thus far. This is a long-term play for us, so time will tell. Next slide, please. So lessons learned, as I mentioned, early education, early and often. Give people a solid foundation, for us at least a foundation to start with, and build upon that foundation. I think we did a pretty good job lining things up, educating folks, putting them in the right order, ending with the POB. But this is a never-ending story that we're addressing, but I think it culminated with a huge POB, and we continue to address it. We did go through a process of explaining why it was on the table, given our challenges, the cost mitigation strategies we did employ. Only helped to a certain extent. I know this year, next year, with the POB that we issued, we saved $7,250,000 each of this year and next year in our pension costs because of it. And of course, over time, things will change, and it'll adjust over time. But I think our present value estimated savings is like $170 million on that issue. Again, using POB as just one piece of the puzzle. It's not a silver bullet, and it's not for everybody. We did extensive analysis on a lot of different things and realized that this was one of those that we needed to do to help us. Encourage stakeholder engagement. The city manager had a lot of brown bag lunches with staff to talk about not a POB, but just talk about the CalPERS challenge, where they asked a lot of financial questions. So I think that was important. What I saw as we went through our presentations was we had union representatives actually encouraging council ultimately to issue a POB to help the process. So I think our engagement, our stakeholder engagement helped out. And then last one here, risk assessment and stress testing. Again, I made our underwriters and Mike at NHA jump through hoops on POBs and do a lot of analysis and a lot of what ifs. What if we issued a June 30 and the market crashed? And what does that look like for our POB? And would we still have savings given where the market was? So doing all that analysis and doing a lot of what ifs got me to a point where I was more comfortable. There's always some level of skepticism when you do something like this, and I always will have it. But I just needed to get comfortable, and I did, making sure that I asked enough questions and put the consultants through the hoops. I think that's it. Our next slide. Yep.
Okay. Thank you, Edward. I want to remind folks that they can ask questions by using the Q&A feature on your panel, and the panelists will review the questions. We do want to leave some time for answering questions. So I think there's been a little bit of confusion on where does GovInvest fit in, and I just want to remind folks that we collaborate. Actually down below that we're actually collaborating and complementing our finance team. We're not competing with them if you get into the transaction part of the analysis. But pre-transaction, GovInvest does have a growing customer success team that includes that dual perspective of both actuaries and former finance directors. And all that's covered, as I mentioned before, in your licensing agreement with GovInvest. So myself and other senior consultants from the industry are available at your disposal as part of your licensing agreement. But we can also help you with long-term forecasts. Of course, we offer labor costing software and analysis, and the ability to look at other cost-cutting options. All should be exhausted prior to restructuring with municipal securities, including looking at the opportunities that we will look in a minute at a couple options in restructuring your UAL that doesn't involve municipal securities, and again, developing a pension and OPEB funding policy we believe is also critical, whether or not you choose to go down the POB road or lease revenue bond road. But as far as the transaction analysis, GovInvest, as I mentioned, collaborates and complements your financing team. We do not compete with them, so it is a free service. We can, we pride ourselves at, helping our clients save time and money, stressing education and transparency, as well as that unparalleled support. So as part of the support offering, you do have a team of folks that are there to help support your your municipal advisors to do that stress testing. And the software obviously involves rich visuals that will aid in both in the education and transparency of some of this complex information to your stakeholders, and then that unparalleled support that's free of charge with your licensing agreement. So one of the things in pre-transaction analysis, I think everybody's familiar with additional discretionary payments and Section 115 plans. So we can help either if you've got amounts in mind, we can show you what those savings will amount to. But we can also flip it on its head and say, okay, well, what if you were to stretch out this obligation to lop off this peak? If you were to restructure over 20 years, then in order to meet the savings test, there may require an upfront contribution, and that could be, whether it's an internal borrowing or using from your reserves or use of surplus. You can make an upfront payment and potentially stretch out your payment structure over a 20-year period with CalPERS without considering municipal securities. And that's the sort of analysis we will do for you, whether or not or prior to setting the course for a transaction. So if you get into when we get into the actual transaction analysis, you decided that POB is the way you want to go, or at least evaluate it, then we can help your financing team to do that sensitivity analysis. Why is it important? Well, retirement plans are highly sensitive to investment, both the assumptions and the actual experience. So we can model several different scenarios of actual investment experience, or what if down the road CalPERS actually lowers the discount rate, and but the actual experience, we can go out and plug in different experience for 30 years. And provide that analysis. So as they mentioned, when an agency deposits large sums of cash into the retirement plan, it's a little bit counterintuitive, but that infusion of assets can amplify your gains and losses. So you're leveraging your obligation, borrowing money, putting it into the market. And if the market does well, it's going to amplify your gains. If it underperforms, well, then it would amplify your losses. So that's why it's so important to do the analysis. And based on that new experience loss layer, you might find that a POB ends up, that loss layer with a POB may be larger than it otherwise would have been if the POB was not issued. So that's something that your stakeholders really need to get their head around and understand. It's not just a pure arbitrage move between the assumed rate of return of 7% and your borrowing rate. It's what CalPERS actually is expected to earn over that period. So with that underperformance by the retirement system will possibly eat into the savings that were projected during the POB analysis. And so it's critical to understand how much of that savings would be eliminated and what type of PERS returns would need to occur in order to make an agency worse off having done a POB. So it's critical information for your, ultimately the decision makers, and then so they can make a decision with their eyes wide open. And of course yourself, that you can help guide your stakeholders in the right direction. So some basic visuals that is usually done in the stress testing is to say, calculate if PERS does earn the 7% return, and based on your predicted borrowing rate, what sort of savings would you have? It's usually measured in PV savings, which is the present value of the savings divided by the outstanding debt that you refunded. So with 7% returns in this example, it may have been represented 100 million with or PV savings of 100 million or 30% of your UAL. But if CalPERS underperforms at 6%, you have to look at that possibility. If they're consistently below, on average, earning 6%, okay, well, that will chew into your stated savings. So maybe you're at PV savings of 67 million, not the 100, or 20% of your UAL. And then even look at losses that were similar to what happened after the 2008 or Great Recession, immediately after the POB. So your POB savings might be further reduced, especially if they're consecutive, minus 24 and minus 8 losses, what that would do to your transaction. So that's basically it in a nutshell. It's 11:40, so we want to leave time to answer questions. So I'd ask all the panelists to turn your mics back on, come back on to the screen, and let's take a look at some of the questions that we have. So we have one saying that says, with cities issuing millions and billions of dollars in debt, we see how this may be advantageous to us, but do we have the perspective of CalPERS to know how our decisions will be advantageous or disadvantageous to them? I think from everybody feel free to jump in, but I think from CalPERS' perspective, if they have additional liquidity infused into the system, gives them more options to invest in the market. One, to either provide liquidity or to take advantage of options, where they can make other investment decisions. But do any other panelists want to chime in on that question? And again, for the folks in the audience, please use the Q&A feature.
Dan, this is Mike. I could just add on to your statement. I don't know that I could speak from the perspective of CalPERS. I got to think that it's, they prefer having more liquidity in the system, as you mentioned. But I think, there's two sides of the equation, and that's always the case. There's what can you borrow at, which is dictated by the market. That could change. We've seen that the market is strong right now and that there's investor interest, that rates are very low, but that could change very quickly. And then on the flip side, you have the equities markets and what is the potential for CalPERS returns in the future? And so you got to think about things, where are equities right now? There's a lot of nuances with, when is the right time to give CalPERS money during the fiscal year, whether they're having a good or bad year. There's a lot of nuances with that that should be taken into account. A lot of quant that's probably too much for this call, but hopefully that answers some of your question.
Okay. We have another question. Have any members of CalPERS ever suggested closing the plan entirely and replace it with the defined contribution plan? The pension model seems outdated and unsustainable. I don't think you'll have any disagreements here that a defined benefit contribution plan shifts the risk to the employees. So ultimately, that is what the employer's goal is. Unfortunately, it's not so much a penalty, but the termination clause in CalPERS, will be that they're going to use a lower discount rate applied to your UAL. So the termination payout may be just, it's usually astronomically unpalatable for the agencies to consider termination from the existing CalPERS plan. Does anybody have anything else you want to add to that question? Okay. So our next question says, I believe CalPERS said this morning in their form that their returns for the last year were 4.7%. How does this impact the decision? Mike, do you want to take this? I mean, this is exactly part of the analysis that we want to take a look at.
Yeah, you know, I'm not sure that how impactful it is to the decision process, but I think logistically speaking, it's important to note that that 4.7 has not been incorporated into the most recent valuation. So if you were to be doing a POB right now, you're paying off your UAL as of June 21, you cannot pay off the new UAL that's going to be added on from that 4.7, which will be in the next valuation report released next fall. I think on the flip side, right now, CalPERS is having a very good year. So I think a lot of those losses from the 4.7 will be offset in the coming years with the new valuation reports.
You're muted, Dan. Dan, you're muted. Are you speaking?
Thanks, gentlemen. Winding back the clocks to folks that aren't in California, Mike and Brian, can you speak to how the reinvestment risk can be abated or mitigated more easily for non-California clients, and then also address who actually, the difference between a POB and a UAL is, are both of those repaid by the repaid from general fund resources, or are they repaid, they added to the tax roll?
Yeah, and maybe I'll start with that, Dan, and then Mike, you can kick in. So, obviously in every jurisdiction, there's different state statutes and state constitutions to deal with. And, many other states don't have the constitutional debt limit issues that we do have in California, but there's also other states that don't have explicit ability to issue sort of pension obligation bonds, which are sort of like a working capital financing directly. So, if you're in another state, you'll have to carefully analyze sort of your fundamental legal framework and your ability to do that. Also, in many other states, there's the ability to levy ad valorem taxes to pay for debt service on bonds. So that may be an option that would sort of forego having to use general fund sort of resources to pay for that. But again, it'll really depend on what state you're in and the legal framework there. Mike, if you have anything else you want to add to that.
I don't, Brian. I mean, I think it is very state specific, but it does obviously with a CalPERS POB, you are required to extinguish that debt immediately on the day of closing. So, if you do go the lease bond route, or perhaps you're in a state where there's some more flexible options, it does put on the table some more dollar cost averaging strategies, whether you want to space out your deposits to your retirement plan manager, or perhaps even put those proceeds in a 115. So very specific though to your individual state in those legal limitations.
Yeah, and then Dan, one other thing I forgot to mention previously when I was talking about just POBs and the validation process, just that I want to mention for the group, and it's important, is that if you file a validation action and you get a judgment, we normally, as part of that validation process, will validate the issuance of the current POBs and then future POBs to issue to take out the UAL. So by sort of investing in that judicial validation process, you've sort of set up your ability to issue future POBs in the future to pay off future unfunded liabilities. I just want to make sure folks were aware of that.
Yeah, so you can actually go down the road of through the judicial validation and not actually pull a trigger on a POB, but you could just
Correct.
have that at your side as another tool in your toolbox. Right?
And Riverside is a prime example of that. You know, the judicial validation that we used to issue our POBs, issued Riverside's POBs in 2020 was a validation action that was actually filed back in 2004 that authorized the issuance of additional bonds in the future to take out the UAL. So Riverside did not have to go through and file a new validation process.
Hey, Brian, how much time does that save? Because I know that was helpful for us not to have to go through it again.
Yeah, I could save up to 3 to 4 months to not have to go through that process. And so it's sort of like a one-time investment.
So we have another question, Eric, maybe for you regarding pension policies. This individual states that pension policies are great to have. However, these are adopted annually and can change with future councils and leadership. Any thoughts on how to make the pension policies to be more lasting and durable over time? So whether that's legally or, you know, I guess, Brian, other than a policy, I guess they could, you know, what other options might they?
Well, the other options would be sort of financial covenants built into the bond documents, but, you know, we wouldn't necessarily want to restrict our clients. We would advise against that. You know, circumstances change, things happen, and, you know, policies are policies, and I understand, you know, the desire to sort of tie future council's hands, but, you know, we don't normally want to bound them in unnecessary financial covenants that aren't needed to market or sell the bonds at the lowest rate. I don't know, Edward or Mike.
I would agree with that, Brian. That it's a tricky thing to do. I know that there's a lot of discussion around that in Chula Vista. It's a very thoughtful policy in Chula Vista, and I certainly there is a supermajority thought to changing policy, something that's so central to financial flexibility. But I really punt this back to Edward and Dan. You know, putting financial policies in place that make common sense is one thing, and to tie council's hands for future flexibility. How do you think?
Yeah, I can speak to this. I think it was important for us. Our pension funding policy is pretty straightforward and basic, but we made sure that we got buy-in from council to the extent that even now, as we talk about challenges and issues, they refer to setting aside money in the Section 115 trust because it's part of our funding policy. So I think it was an important part of the education process, and we always refer to it. Of course, it could change, but typically in our situation, the only time it'll change is if we present some amendment to those particular items to council for readoption. But it is a benefit. It was and it has been a benefit for us because it's constantly referred to as we talk about issues.
Just from my perspective, I'm never a fan of either policies or legislation that really ties the hands of your finances, because you never know what's coming around the corner. But it's still useful to provide council assurance and maybe even your credit agencies that you've put a lot of thought to it. You may have reviewed this with your municipal advisor, come up with a policy, and it was adopted. It was reviewed by your finance committee. So when your next council comes in, they could see, hey, this is the direction staff was previously given, and so they, you know, would have to openly, you know, overturn that previous policy. So that's my 2 cents on the matter.
Yeah, and I just end with the fact that last week or the week before, we did have a conversation with Standard & Poor's, and that policy was discussed in detail. And this conversation was drilled down upon by the rating analysts, how that policy could be modified or, you know, reversed, if you will. So it is an important consideration what and how you put that policy in place. There's pros and cons to it.
So this is a little bit of a rehash of a question I think we answered, but do you find the adoption of a policy the best way to institutionalize city government's pension funding? It seems that councils come and go and their priorities shift as a result.
I can speak to Riverside. I think it's helpful for us. It was helpful for us because typically when any dollar available to be spent, it would be spent. So this is at the forefront of their minds now with the pension funding policy, knowing that there are some restrictions that can be changed and overridden. But I think it's helpful because it lays the foundation of having that conversation of the fiscal challenges. And as we get surplus, as we fortunate to have for fiscal 20, we talk about that surplus and how we're going to address our issues going forward. So from my perspective, it's been beneficial and helpful. It's not handcuffing us to any degree. And we do have 4 new council members out of 7 as of last a year ago, December. So they're on board with it. They understand the challenges, the issues, and are completely fine with how the policy was structured.
And this is Mike, just one thing to add to that question. I think I want to make clear that a lot of these pension funding policies do a little bit more than just funding pensions and OPEB. I think that's one core component, perhaps depositing money into a 115 trust, but a lot of the policies we've seen just provide framework around how that savings might be utilized in terms of building other reserves of the city. So operating reserve, emergency, contingency type reserves as well. So it's not just all about funding pensions in the future, but it's putting some safeguards around how the city might best leverage those savings that will occur in the early years, certainly.
Valid point, because we do have a general fund reserve policy, and that's first and foremost what we look to. And anything excess, then we rely on the pension funding policy to provide us some direction.
Okay, gentlemen, I don't see any additional questions in the queue. It's 11:55. Is there anything else that anybody wants to add that perhaps they may have forgotten to emphasize? With that, I want to thank both the audience for participating, and NHA Straddling and the City of Riverside for coming up with this great presentation. We hope you took away some value from this presentation, and feel free to reach out to any of us as a resource. Our contact information is here. And as I mentioned, both the PDF of the presentation will be distributed by the end of the week, as is a link where you can review the presentation again. With that, I'll say thank you very much and have a great afternoon.
Thank you.
Thanks, everybody.